Okay, so you want to own a trailer park. No, you don't. Nobody does. Nobody stands in a drive-through line dreaming about gravel roads and lot rent. Every other business in this series is something people fantasize about owning. A McDonald's, a hotel, a gym. This one is the opposite. It's the business your friends would laugh at, which is exactly why it might be the best deal on this channel. In 2015, the Carlyle Group, a private equity firm managing hundreds of billions of dollars, bought a mobile home park in Sunnyvale, California. 4 years later, that single park changed hands at a reported price of around $237 million. Warren Buffett owns the company that builds roughly half the manufactured homes in America. Zell, the billionaire who built some of the biggest real estate empires in history, reportedly said no company he was involved with had better prospects than his trailer park business. Here's the one-line secret they all understood. In a mobile home park, you don't own the homes. You own the ground underneath them. The tenants own their homes, and those homes are almost impossible to move. By the end of this video, you'll know what one of these parks actually costs, why the rent checks almost never stop, why the government accidentally made every existing park more valuable each year, and who actually pays for all of it, because someone does, and that part of the story is not comfortable. First, let's define what you'd actually be buying, because it is not what the name suggests. Strip away the stigma, and a mobile home park is one of the simplest real estate products ever invented. You own land, divided into pads. A pad is a rectangle with a utility hookup. You own the roads between them, the water and sewer lines under them, and usually nothing else. There are more than 40,000 of these communities in the United States, holding roughly 4 million home sites, and around 20 million Americans live in manufactured homes. That is more people than live in New York City, Los Angeles, and Chicago combined. This is not a niche. It is the largest source of unsubsidized, affordable housing in the country, and almost nobody built it on purpose. It accumulated, park by park, at the edges of towns, along the highways, wherever land was cheap and nobody important was looking. A typical park runs somewhere between 50 and 300 pads. Below 50, the numbers get thin. Above 300, you're running a small town, with your own water system, your own roads department, and sometimes your own sewage plant. Now the taxonomy, because parks come in flavors. Flavor 1 is the tenant-owned home park. Residents own their homes outright and pay you rent for the pad. This is the version investors love, and you'll see why in a minute. Flavor 2 is the park-owned home park. You own some or all of the homes and rent them out like apartments. More income per unit, but now you're a landlord with roofs, furnaces, and turnover. The economics get much worse. Then there's the community split. Family parks take everyone. 55-plus communities take retirees, and those tend to be quieter, better kept, and prized by institutional buyers. The Sunbelt Retiree Park is the blue chip of this asset class. The model in one sentence: people pay you monthly rent for a patch of ground, and everything sitting on that ground, the walls, the roof, the water heater, belongs to them. So what does a business like that cost? Less than you think. And the comparison to normal real estate is where this starts getting strange. Parks are priced per pad. For a stabilized park, one that's full and functioning, buyers commonly pay somewhere between $20,000 and $50,000 per occupied pad. A decent 100-pad park in a secondary market might run $2 to $4 million. In this series, that's McDonald's money. Except here, it buys you 100 paying tenants instead of one restaurant. Now the number professionals actually argue about, the cap rate. That's the annual net income of a property divided by its price. Higher cap rate, more income per dollar invested. Apartment buildings in good markets commonly trade at cap rates around 4.5% to 6%. Mobile home parks nationally have averaged around 6% in recent years, and smaller parks in secondary markets commonly trade between 6 and 8.5%. In plain English, the market hands you more income per dollar here than for almost any other kind of residential real estate. Normally, a higher yield means higher risk. A dying mall pays a fat cap rate because everyone knows it's dying. So the market is telling you trailer parks are risky. The market is wrong. And it's wrong for the least financial reason imaginable: embarrassment. Institutional money spent decades avoiding this asset because nobody wanted trailer park in their fund brochure. The stigma suppressed the price of an asset whose income, as you're about to see, is boringly stable. And that cap rate math hides a second trick. Because parks are valued on their income, every dollar of new rent gets multiplied. Raise lot rent by $50 a month across 100 pads, and you've added $60,000 a year of income. At a 6% cap rate, that one change adds roughly $1 million to the value of the park. Remember that multiplier. It explains almost everything that happens in the second half of this video. Because when you open the books on one of these parks, the expense column looks like a typo. Average lot rent in America runs somewhere around $300 to $400 a month. It ranges from roughly $200 in the rural Midwest to more than $1,000 in California and Florida. Take a 100-pad park at $400 a month. That's $40,000 a month, $480,000 a year for renting out dirt. Now the expenses, and this is the part that makes apartment investors jealous. When you own an apartment building and a water heater dies, you buy a water heater. Roof leaks, your roof. Tenant moves out, you repaint, recarpet, and re-advertise. Apartment expenses commonly eat 45 to 55% of the rent. In a tenant-owned home park, the water heater belongs to the tenant. The roof belongs to the tenant. The broken window, the worn carpet, the leaky faucet, all tenant. You maintain roads, pipes, streetlights, and mowing. Industry numbers put park expense ratios at roughly 30 to 40% of gross, and the low end of that range belongs to parks on city water and sewer. Run the rough math on our 100-pad example. $480,000 in, maybe $150,000 to $200,000 out, and something like $300,000 a year lands in your pocket before debt payments. From dirt, gravel, and pipes. No fryers, no staff of 40, no franchisor taking a fifth off the top. And turnover, the silent killer of rental profits, barely exists. When an apartment tenant leaves, your unit earns nothing until you refill it. When a park tenant leaves, they usually sell their home right where it sits, and the new owner starts paying you the same lot rent. The home changes hands, your income never blinks. Park owners like to say they have the only tenants in America who mow their own lawns, fix their own roofs, and cry when they have to leave. So you collect near apartment rents on a fraction of apartment costs, with tenants who almost never leave. Hold on, why do the tenants almost never leave? The homes are called mobile homes. If the rent annoys them, they can just tow the house somewhere cheaper. They can't. And that single fact is the entire secret of this business. Here is the most important sentence in this video. Mobile homes are not mobile. The name is a relic. A modern manufactured home gets delivered once, gets set on blocks or a foundation, gets skirted, plumbed, and wired, and then it stays. Moving one means hiring a specialist crew, permits, escorts, teardown, transport, and reassembly. Recent industry guides put a single-wide move at around $6,500 and a double-wide around $11,500, with full moves commonly landing between $5,000 and $20,000. Older homes often can't survive the trip at all, and many parks refuse to accept homes past a certain age. Now put that next to what the homes are worth. Many older homes in these parks would sell for $10,000, $15,000, $20,000. The move can cost more than the home's entire equity. So when the lot rent goes up, the tenant runs the math, and the math traps them. Pay the increase or abandon the largest asset they own. They pay. One of the industry's most famous investors described the business as owning a Waffle House, where every customer is chained to the booths. He says the quote gets taken out of context. The context is that he teaches a seminar on buying these parks. Economists call this a captive customer. It's why park occupancy barely moves in recessions. In 2008, when the housing market collapsed and apartment landlords were slashing rents, park owners mostly weren't. Their tenants had nowhere cheaper to go, because there is nowhere cheaper to go. This is the floor of the American housing market. When times get hard, people don't move out of it, they move into it. That's half of the secret. Here's the other half. The supply is shrinking. Starting around the 1980s, cities across America effectively stopped approving new mobile home parks. Zoning boards don't want them. Neighbors don't want them. So almost no new parks get built. And industry estimates suggest something like 1% of existing parks disappear every year, closed and redeveloped into apartments, storage, or subdivisions. Read that as an investor. Demand for cheap housing rises every year. Supply of parks falls every year. Every park that dies makes yours worth more. And the government's own zoning rules guarantee no competitor can ever be built next door. An asset this strange was never going to stay hidden. The smartest money in America found it decades ago. Start with Zell, the man who practically invented the modern real estate investment trust. His company, Equity Lifestyle Properties, became the largest owner of mobile home lots in the United States. From the bottom of the financial crisis in 2009 to early 2020, its stock returned roughly 1,200%. Zell reportedly said that no company he was involved with had a better prospect. The billionaire who owned skyscrapers said his best business was pads of dirt. Then Buffett. In 2003, Berkshire Hathaway bought Clayton Homes for about $1.7 billion. Today, Clayton builds roughly half of the new manufactured homes in America. But building homes is the boring part of what Buffett bought. Clayton also finances those homes through its own lending arms. And here's a detail most people never learn. A manufactured home on rented land usually doesn't qualify for a normal mortgage. It gets financed like a vehicle, with what's called a chattel loan, and those commonly carry meaningfully higher interest rates than a standard home loan, partly because the homes tend to lose value like vehicles rather than gain value like houses. Clayton sells the insurance too. Build the box, finance the box, insure the box, collect for decades. A 2015 investigation by the Seattle Times and BuzzFeed accused Clayton's lending arms of trapping buyers in expensive loans. Clayton disputed the reporting. The loans remained expensive. Now assemble the whole machine. Buffett's company builds and finances the home. The home lands on a pad and can never affordably leave. The park owner collects rising rent on the land forever. And here's the cruel physics of it. The home on the pad usually depreciates, while the dirt under it appreciates. The tenant owns the part that falls in value. The landlord owns the part that rises. Everything you've heard so far is the brochure. Safe, simple, brilliant. Now we have to talk about what happened when private equity read that brochure. Because the same mechanism that makes this business safe is what makes it dangerous in the wrong hands. Remember that Sunnyvale park from the opening? Carlyle bought Plaza del Rey in 2015. Under the previous owner, rents rose about 3% a year. Under Carlyle, reporting put the increases around 8% a year. 4 years later, Carlyle sold at a reported $237 million, roughly a 58% gain. New residents there have faced lot rents reported around $2,300 a month for a patch of ground. And Carlyle is not an outlier. It's a wave. Researchers count 23 private equity firms owning more than 1,800 parks. Institutional buyers went from about 13% of park purchases in the late 2010s to roughly 23% by 2021, a year when park acquisitions totaled around $9.4 billion. In parks like these, lot rents have climbed about 45% over the past decade. One Florida study found eviction filings jumped roughly 40% in the months after a park changed hands. Now recall the multiplier from earlier. Every extra dollar of monthly lot rent, multiplied across hundreds of pads and divided by the cap rate, becomes $12, $15, $20 of park value. A rent hike isn't collected once. It gets capitalized, priced into the asset, and harvested at the next sale. That's the machine behind the Sunnyvale numbers. The rent increases were the product. The residents were the raw material. Here's why this lands so hard. The median household income in these communities is commonly cited around $35,000 a year. Many residents are retirees on fixed incomes who did the responsible thing. They bought their home outright. Their only ongoing bill was the lot rent. The new playbook raises that one bill they cannot escape, precisely because they cannot escape it. The captivity you were admiring 3 minutes ago as an investor is, from inside the home, a trap. The backlash is real and growing. U.S. senators have opened inquiries into investment firms buying up parks. States are passing rent stabilization for manufactured housing and laws giving residents the first shot at buying their park when it sells. Nonprofits now help residents form co-ops and become their own landlord. If your business plan is aggressive rent hikes on captive seniors, you are betting regulators stay asleep. That bet is getting worse every year. So the honest question isn't whether this business makes money. It clearly does. The question is what kind of owner the money requires you to be. Here's the honest scorecard. As an investment, a well-bought mobile home park is about as durable as private real estate gets. Demand for cheap housing never goes away, and in bad times, it grows. Expenses are structurally low. Turnover is near zero. Supply shrinks by law. That combination barely exists anywhere else, and it's why the smartest capital on earth quietly loves the asset your friends would laugh at. One warning before you get excited. This is not passive income. The glamorous part is the spreadsheet. The real part is a 50-year-old water line bursting at 2 in the morning, a septic system from the Nixon administration, and collections, in person, from people you know by name. The owners who thrive treat it as an operating business. The ones who get hurt bought a spreadsheet and inherited a plumbing system. As a moral position, it depends entirely on how you run it. There are two versions of this business. One owner keeps rents near market, fixes the water lines, and provides the cheapest, decent housing in the county while still earning returns most landlords envy, because the costs are that low. The other owner buys the same park, raises rent 20% on people who cannot leave, and harvests the trap. The spreadsheet barely tells them apart. The residents can. The stigma that kept prices low is fading. The regulators are waking up. The easy version of this trade, buy cheap dirt and squeeze, is closing. What's left is the version that was always underneath it, owning the land beneath the one kind of housing America refuses to build more of. Nobody dreams of owning a trailer park. That was the whole opportunity. The fantasy businesses get bid up by dreamers. The unfashionable ones get bought by billionaires. If you want to see how the same machine works on businesses you walk past every day, from car washes to storage units, that's what this channel does. Subscribe and pick your next building.